Bonds are a predictable asset, and there's nothing exciting about predictability. That's why we have Carolyn Moriarty here to help me and this little dude get a few questions answered. One, after such a tough year, why would somebody consider bonds? He was just asking me about that. And two, we're actually trying to figure out his name. So I don't know if you have any guidance on helping this guy get named, but we do have two different types of questions there. So this is Mariner Wealth Advisors, Your Life Simplified podcast. Carolyn, what do you think? We got a couple questions to start there. We'll try to keep it on track.
One is easier than the other, and it's not the puppy name.
I don't know if you have any ideas. We've been trying to figure that out. We got Hudson. We got Frankie. I don't know how you feel about Frankie, Frank the Tank.
Frankie's cute.
Yeah, we're trying to figure things out. So if you don't, I guess maybe have as much guidance, I guess we can let him go. But he did have questions.
Man.
Why consider bonds after such a tough year?
Couple of things. I mean, this is very unusual. The contraction we've seen in the fixed income market. It's been well over 100 years that we've seen this kind of losses in bonds. It's been 50 years since we've seen equity markets and the bond market contract at the same time.
Yes.
So it's highly, highly unusual. The Fed has raised rates a number of times. Inflation is coming down, but it seems it's taking its time. So that said, we're at a point now where the rates are attractive enough, even given, future rate hikes, that you're being compensated to preserving your wealth. And I think that this is, there could be time. If you hold a bond to maturity, the losses are, you will recover your principal, barring a default.
Which is
you
rare.
Are buying and selling, if you're buying and selling and active in the bond market, yes, you're at risk of more losses. But buy and hold strategy at this time, as long as you keep your maturity fairly short, to provide some flexibility in cash flow, where you don't have to sell it at depressed prices. Then I think you're well compensated now. I just saw that I think it's the 6-month Treasury hit 5% today.
Yeah, wild the changes that we've seen there.
Yeah, it's really amazing. It's we have not seen these rates. I mean, really, and exclude the COVID pandemic, the COVID pandemic, exclude that time, the Fed was in the process of raising rates from the end of, it was during 2018. And then, the pandemic hit in 2020, and we went right back to zero, where we were trying to emerge from the housing crisis in 2008 and 2009. So from 2008 to 2009 to 2018, we had a 10-year, bull market in bonds, and then the Feds, we needed to tighten.
But that was largely driven off of, again, just price appreciation, right? Which maybe isn't. Not to cut you off there, but maybe isn't where people, really are, as they're looking at bonds, they're maybe not thinking I'm buying this for appreciation. They're buying it for the income.
Exactly.
So maybe that bull market was a little bit misleading. And I think, where we can maybe start, and then we'll, twist this into, okay, should you consider bonds differently here in 2023? But I think maybe where we should start is just understanding the mechanics of bonds, right? So help us understand real quick, because you obviously spent some time in the investment world trading, really working with the mechanics of bonds, your CFA, your CFP. Just help us understand the basic structure first of a bond and how it works.
Buying a bond means that nothing more complex than you are loaning money to an entity that could be a state, it could be a municipality, it could be a corporation, it could be the federal government.
Mm-hmm.
So they have provided a promise to pay you back at a certain interest rate over a certain period of time. So the interest rate is also called a coupon. The principal is also called par value. So you can buy and sell bonds in the secondary market at a price that might be above or below par. So if it's below, you're buying a discount bond. If you're buying above, you're buying a premium bond.
Mm-hmm.
And the factors that determine whether it's a discount bond or a premium bond are the prevailing market rates in the market. Mm-hmm. So, for example, today the 6-month Treasury is 5%. So if there was a corporate bond out in the market that was issued years ago, maybe 10 years ago, and that coupon on that bond is 6.5%. So that by buying that bond, I'm getting a stream of interest payments that pay 6 or 6.5%. That's higher than what I can get today. So that would sell at a premium. You have to pay up to buy that bond.
It's a teeter-totter effect.
Exactly.
Yeah, so, where you have interest rate on one side, and as interest rates fell over the last decade until obviously up to 2022, where they sharply increased, as they fell, that teeter-totter went like this, and price appreciated, right? Because theoretically, the bonds that had higher interest rates were worth more. That's that premium that you're speaking to, right?
Exactly. Right. Because you have to discount those future cash flows, and not to get too technical here, but you have to discount what you receive in the future at a 5% rate, basically. Mm-hmm. So the higher that rate goes up, the more, your present value comes down. Mm-hmm. And that's kind of the dynamic between where rates are going and where the price has to go.
Right.
You have to discount that future cash flow stream back to today.
Okay. So there's this relationship that exists, and there's these different metrics that are within bonds. You hear yield to maturity, yield, all those different types of things. But rather than maybe going too deeply into that, as you just laid out, I think a nice basic understanding. Again, there's interest. There's some type of time that's going to be associated with this. There's two measurements of time. You have duration, and then obviously you have just maturity. So those are actually two different types of measurements. Again, those get confused often. Duration has to do with the sensitivity, whereas the actual length of the bond is the maturity date. But again, there's that relationship. So you get paid that interest rate over a period of time, and eventually you get your principal back. That's if you own the bonds individually. Now, the question is, how do you apply this to your world? Because investors, we like the idea of receiving some form of compensation for gifting our money, in this case, to some corporation, if it's a investment bond, let's say. So how does this work within your portfolio? We know there's active and passive possibilities here, active and passive ladders. How do bond strategies really play into somebody's world, and what should they be thinking about?
There's the passive strategy worked well when interest rates were low, because you're already, again, remember the dynamic between rates and where the price of the bond is. So we're rock bottom at rates, which means we're probably peak prices. So to invest in a passive strategy within that kind of environment, you did fine. You did well. Once you start increasing the rates, the prices are coming down, and there's no manager behind determining, whether or not to sell or keep specific bond issues, because you might have an improving credit within that passive strategy, but nobody's looking at it because you bought the index, and that's all it is. You were just, it's a straight purchase of the index, and they buy and sell the component, the constituents of that index, with no regard to credit quality, valuation, or duration.
Mhm.
So this is where active management in a rising rate environment can be very, very helpful, because you do have active portfolio management, picking the high quality names or even the improving names, that are attempting to move up the rating scale. So going, say, from a triple B up to a single A.
Mhm.
And you can get price appreciation just from, the improvement in credit quality.
Which is something I think that isn't, understood or referenced. And part of that, I think, is all of the attention really in the investment sphere goes towards either one, shiny rocks such as, NFT and crypto this past year, or, goes to equities, stocks, right? Bonds, obviously, the predictability takes away from the attractiveness to even learn more about them. Which in this case, something you just highlighted there, I don't know if, probably a lot of advisors aren't aware of that factor. Financial services representatives, as far as like, if, the bond gets, let's just say an improvement in their score, goes from, in this case, the triple B, I think you mentioned the triple A in your example,
Single A.
single A, they would improve, obviously from a price appreciation standpoint, because that would make sense, because they would be thought of as relatively safer from
Exactly.
a default standpoint. So I guess, again, I think this still brings back, the question of like, okay, because you're laying out active in a rising interest rate environment, an active bond manager can maybe sort through the noise a little bit and help identify those players. There's an obvious added cost to that, to have some form of active management. The question is, like, if I'm, let's just say, a pre-retiree or a retiree, and I'm thinking about, hey, I want to be more conservative with my portfolio. Should I just buy like a bond fund, or should I, potentially look into getting an active bond manager? And that's very specific, uh, to somebody's situation, as far as like whether or not they want to do that. But I think, before all of that, maybe the first step is getting a little bit of understanding, like, okay, how bonds work. And then maybe coming back to the fact that, is we've seen these increases in the interest rate environment, you have bonds that are actually paying out, a legitimate interest rate now. 2-3 years ago, I mean, you'd be lucky to keep pace with inflation with some of these investment grade bonds. And yes, inflation is still high right now. But, if you're looking at, let's say, a bond that has a 5 to 10 maturity length, and it's paying, a significant amount, let's just say 2 to 3 times what it was maybe a couple of years ago, you might want to consider that at least a little bit more than you did a year or two back, when you weren't getting much and it was barely beating inflation. So I wonder, what you think about that. Should investors now be considering bonds maybe potentially more because they're actually just paying more?
The bonds are paying more. Yes.
Yeah. So,
Yes. Yes.
from an interest rate standpoint, so new bonds, let's say they're being traded. The question is, okay, does this make sense to consider a larger percentage of bonds in my portfolio, because I can actually get a better return now? As you look out to just the interest rate world, you get returns now on your money market. So you didn't get that a couple years ago.
Right.
And you're starting to see new bonds being issued with actual legitimate returns, at least significantly higher than what they were a couple years ago. So the question, I just had for you is, does this make sense for, let's just say, the individual investor to maybe consider allocating a larger chunk of bonds in their portfolio at this point in time? Or is it, no, you should always have the exact same percentage regardless of the environment? It just all depends on your certain, situation or
I
your
think
goal.
I think there's elements of both.
Yeah.
I think that to rush into fixed income land right now, where the Fed is still actively tightening, might be early. Um, there's time. And another point I wanted to make too is that the longer that that these rates remain elevated, it's kind of like um, the bright side of a bad story is that you know issuers are issuing debt every single day, and that the longer that we're in a higher rate environment, the more issues that go out at these rates in the
Hmm.
secondary market. So it's more opportunity in the future for buying, higher rate paper. I'd also mention that, as part of an active strategy, you can ladder maturities so that, and this is especially important for retirees where they have an annual income stream that they need to live on. And so we can construct a bond ladder where I need, for example, an investor needs $50,000 every single year for the next 10 years. So we buy a bond that matures in 2024, 2025, 2026 with 50,000 par value. And as that matures, then, they have the income that they need to live on. If they have less than that, if they spend less than that during the year, say 40,000, well, I've got an extra 10,000. Okay, so let's reinvest that. We'll roll it over into a longer maturity and earn a higher rate.
Hmm.
So I think that there are many strategies that are available to active management that are not um, available in a passive strategy.
Right.
I mean, it
Passive
works at,
strategy.
at certain points, but like I said, I think in a rising rate environment, investors are better off with an active manager.
Yeah. Yeah. I mean, when things change that quickly, I just know, like, from personal experience, a couple years ago, modern portfolio theory was very much, getting challenged because there's let's just say a historical allocation of just stocks and bonds. One, you had simpler times to where there just wasn't as many different investments to choose from when modern portfolio theory, let's just say, was getting rolled out. But as times have changed, you have new investments, but you also had such a low interest rate environment that, very much so, you looked at modern portfolio theory and you looked across the board. A lot of different investment management firms were saying, okay, maybe it's not 60% stocks and 40% bonds; it's 60% stocks and 20% bonds, and X amount, all of these other different asset classes. I think as the interest rate environment has significantly shifted upwards, again, it's time maybe for advisors, investors to revisit their asset allocation and ask themselves, what is it that is going to be my buoy here, my conservative asset set of asset classes that's going to be best set up to weather the storm. And when you have interest rates significantly higher, I think it just raises again that question of, okay, what should that conservative just allocation be made up of? That 40% that I mentioned, whereas traditionally it was just stocks and bonds. There's all these different asset classes, all these different ways essentially to increase wealth today. So people are wondering, what should I do with that 40%?
So
Uh, I think it's a real question. Once you take a few steps in, I think it's a real question that a lot of investors arrive at.
yeah, yeah, and I would say that probably a good first step is take a look and see how much you're spending
Hmm.
as a percent of your portfolio. Um, if again, the traditional 4% withdrawal rate is still kind of appropriate, especially now where, at least now the 4% withdrawal rate can be earned, right, in this environment. So if your withdrawal rate, starts to edge up over what your rate of return is available, then I would argue that, more of the portfolio should be allocated to fixed income because,
Mhm.
you need to preserve that capital. You can make an argument where you need the growth, right? And then you've got to factor in, client risk tolerance, their age, are there other income streams?
Mhm.
So
Yeah,
again, it's
multiple
a
variables.
holistic approach to not just, where my portfolio should be allocated. It's a very much a very, comprehensive wealth management decision that,
Yes,
you have to take in a bunch of different,
as
factors.
always, as always. But
Mhm.
just listening to you and just in general thinking of this, I think it really does present that question in a different way. Like it brings it back up. One constant we have is change. If interest rates are significantly changing that much, you saw people truly not just considering I bonds, but buying them in
Yeah.
this past year. I mean, when was the last time that you had clients, and I put out like an inflation piece around this? I mean, but when was the last time you had clients asking about that? It's been a while. And so you can see as the change in time comes like a wave, it brings newness. And I guess to finish off today, the question is around that change. And this is always a question I think investors have too. In a rising interest rate environment, should we be buying bonds, right? The Fed's laying out, and I'm relaying this question that comes from investors here. Should we be buying bonds when the Fed is clearly stating that interest rates are going to continue to rise? If that has a negative effect, let's say from just a correlation standpoint, a negative effect in the way that it can decrease price of bonds, should we be buying bonds in a rising interest rate environment?
You don't have to buy all your bonds on day one. We can dollar
Very true.
cost average just like an equity. And you can capture that yield over time.
Yes.
Um, Again, I'm going to go back to the last time that we saw 5% treasury rates, and it was 2000, April 2007, I believe, 6 or 7. And then, we had the housing crisis and we had the banking crisis, and then we had an international crisis. And it took 10 years for us to start to return to some semblance of growth. And the Fed began hiking rates in, I believe it was late 2017, 2018. And then, another crisis emerged, and we, they slashed to zero. So the point of that is that we have attractive rates now. Why not allocate at least a little bit? Even
Mhm.
if you don't want to go the full 40%, allocate a little bit of your portfolio and, earn something for preserving capital. Because
Yeah.
this is these 100-year storms, these black swan events are happening more and more often.
Yeah. Well, I think like last year was a truly difficult year for bonds, but if you look historically, like 2 years in a row of that, I'm not sure, how many times that's happened. But I would guess it's single digits in the last century as far as 2 negative years in a row for bonds when you consider their total return, right? So interest and price. But I think also, one thing to just consider here is you're maybe looking outward and you're thinking, should I purchase bonds with inflation going up, with, interest rates potentially rising? It all has to do with expectations. So there is in just a part of that, let's just say equation or makeup with bond pricing that will take into account inflation or risk of interest rate increases, which typically inflation and interest rates going up are correlated. So if that expectation is already there, the Fed is clearly laid out. Yeah, we're going to continue to raise rates at least over the next couple quarters. They've laid out their plans there. If that's the expectation from a market consensus standpoint, then the question becomes, will the interest rate and inflation essentially exceed that expectation? If it exceeds that expectation, then you might see a poor, let's just say, price play out for bonds again. So it comes back to expectations, and that's something I feel like I'm constantly talking about with just clients of mine is, it's not necessarily like what's going to happen in the future. It's much more expectations. What happens in the future, is it above or below expectations? So you might see, for example, inflation go up by 1% above expectations, and that negatively drives down price. But you might also see inflation still go up, but it's below what the market expectation was for inflation, and therefore, you might have a slight bond appreciation out of that. So come back to the expectations. It all has to do with the expectations. If the expectation is we have a rising interest rate environment, the question for bonds moving forward, let's just say the larger question is, will inflation outpace current expectations? Because that would obviously hurt bond price appreciation more, or just hurt bond prices in general more. Or, will it stay in line or below? That's the bigger question. So that's typically what I come back to when I'm talking to clients is, okay, it's a matter of expectation. So
yeah, absolutely, and all of the factors that factor into that expectation, right? The externals, the inflation,
yes.
the economic
risk
growth,
of default,
right?
Everything.
Risk of default. So I would nuance my previous answer with, take advantage of these higher rates, but let's do it in a shorter duration bond. So duration measures that price sensitivity. So since we don't know the future, we only have our expectations, we can buy a very short maturity bond that is going to, the volatility in the price of that bond is lower than it would be, say, for a 10-year bond. So I'm talking maybe a 2-year maturity, or even lower. I mean, you could go ultra conservative and just buy a T-bill, which is, basically 3 months and 6 months. And then as time goes forward, you're earning 5% on a 6-month treasury. While you're waiting for the market to sort itself out. I would put it that way.
Yeah.
If you want a more longer term approach, then keep the duration short,
right?
But take advantage of some of these yields right now.
And that has to do with if you're potentially trading while you still own the bond, right? Whereas if you held it to maturity, you could just collect interest and get your principal back.
Right. Right.
And, more what we're talking about is trading while you actually own the bond, because then you would be dealing with the teeter-totter price effect, if you will, right? So, well, hopefully this was a helpful episode. We know it's a little bit more technical, and bonds, again, not always the most exciting topic, but they do make up a large percentage of somebody's portfolio quite often. And so they're worth visiting, especially as we've seen the crazy interest rate environments that we've seen. So, again, my name is Michael MacKelvie. I was joined today by CFA, CFP, Carolyn Moriarty. Appreciate you coming on. This is Your Life Simplified. Make sure to subscribe wherever it is that you're listening to this. Hope you enjoyed, and you take care.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Investing in securities involves risk of loss, including loss of principal, that clients should be prepared to bear. Strategies or investments discussed may fluctuate in price or value. Past performance is not indicative of future results. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.